in the market we're in, we've seen some good price corrections, and that is changing the landscape for investment properties. In this analysis, we're looking at primary, secondary, tertiary markets. In this case, it happens to be in the east. So those markets in this case are Oshawa, Peterborough, and Belleville, primary, secondary, tertiary, respectively. And we're looking across those to do a compare-contrast for a turnkey duplex in a larger lot that has the potential for a third suite down the road, an ADU in this case. So we'll look across what we have here as a dashboard. I'm going to focus on the left here to start. We're starting with the tertiary market, secondary followed by primary. And in this dashboard, we're capturing the kind of major KPIs for the property, and then we have a 5-year projection on the mortgage pay down, appreciation, and cash flow illustrated in the pie chart. Okay, so purchase price, think in the tertiary markets for a turnkey duplex in a larger lot with the potential for an ADU down the road. Price somewhere in the 580 to 600 range. There are exceptions to that. A really nice oversized turnkey duplex just sold in Belleville, right in the mid 750s, for example. However, you can pick them up for 580 and 600 at a more regular sized footprint of duplex. Okay, so in this case, we've got this one listed at 594, capital needed around 133K, monthly cash flow projected to be 857. I'll cover the financing terms that produce that in a second. 5-year ROI around 36%. That's annualized simple ROI. And total profit after capital payback, if you were to sell in 5 years, projected to be 243. In the secondary market, think a turnkey duplex on a larger lot with ADU potential, somewhere in the 650 plus or minus range. Capital 146, monthly cash flow projected to be 548. And 5-year annualized ROI 33%, total profit around 243 again. In the primary market like Oshawa, average price for a turnkey duplex, less potential for an ADU. Still could add a third unit though, but harder to get larger plots of land. The closer you get to Toronto, the more premium land becomes, and so they get a little bit more difficult. But in any event, nice turnkey duplex with a third unit potential around 810. Capital required in this case, so what I did was I lowered the LTV to 75% so that your capital's higher to protect your cash flow. So capital's around 222,000. That's down payment, closing costs, and reserve fund for each of these cases. Monthly cash flow 100 per month. Annualized ROI 23%. The reason why that's a bit lower is because I lowered the LTV, more capital, less ROI. That's the relationship there. Assuming all other variables are the same, that is. Total profit after capital payback, 265 if you were to sell in 5 years. And there's the pie chart for each one of these. Okay, so let's look real quickly at Oshawa. Again, you can see the LTV is 75%. For each of these, I've assumed similar taxes, 8% in property management, 3% in vacancy, insurance, $1,700 a year, 3% in maintenance and labor. And that's really what's produced that cash flow number. For the financing, I've assumed the current 5-year fixed rate on a mortgage, 4.39%. Not to say that that's the mortgaging terms that I would recommend, but it's a way to plug in today's numbers and make it static across all 3 of them and have a 5-year predictive forecast for where the property is projected to go. So that's why I've chosen that. I actually think a variable would be much smarter, at least in the next 6-12 months, and then lock in. But for now, we've kind of produced a stable side-by-side, apples-to-apples comparison by putting in the 4.39. Okay, the other 2 properties in the secondary and the tertiary are at an 80% LTV, with everything else roughly the same. That's where those numbers have come from. Now, if we look at this, this is for the 5-year projection. We can easily modify that to be 10 years just by changing this drop down. And now we see that our projections, if we were to sell in 5 or 10 years, and that's with doing nothing else to the property, not yet adding the third unit. There's another model that I have that's far more sophisticated that more in a more nuanced way predicts what if you were at a third unit in third year, for example, and change your financing. That's got a lot more graduated steps to it. That's far more accurate than this. But this is just a simplistic 5-10 year snapshot to show the three different markets side by side. So if we were to go 10 years, the ROI jumps up, obviously, because there's more time for appreciation, more time for mortgage pay down and cash flow. So the pie charts, they're reflective of that. And then the overall profit, if sold in 10 years after capital payback, is 506, 530, and 619 respectively across tertiary, secondary, and primary markets. So it's a unique opportunity. In my consultations over the last number of months, the secondary and tertiary markets continue to be as an entry point into the market. I'm not talking about, as you can see, the overall gross profit in 10 years and 5 years was actually a little bit higher, even with a lower LTV in the primary markets. It's not to say these are good, better, best, or there's something wrong or right. No, that's not it. It's always pros and cons. And ultimately what fits you really is the more guiding principle. So numbers are just one piece of the puzzle. But that said, the secondary and tertiary markets are an easier entry point if you take a snapshot of today, because the ROI is nice and strong on a projected basis and the cash flow is strong, largely because the price point for purchase is much less and the rents are very, very close. And that's roughly where that lands. Now let's look at the other component of this. This is taking, I'm kind of mixing geographic regions a little bit, so I want to call that out because it's an important note to make around what's being shown here and the extrapolation that's being done. So in both charts, we're talking about sales activity up top, average price down below. We're looking at the first 3 quarters of 2024 versus the predicted first 3 quarters of 2025. Okay, so this is BMO and CREA's predictions. BMO is on a Canadian national level and CREA on a provincial level. So Canada versus Ontario versus Durham is really the extrapolation that we're doing here. And so there will be some slight inaccuracies here, but it's still good predictions that we're drawing from both CREA and BMO in order to kind of say, what are we looking at right now versus what do we think is coming as we crest into 2025. So in terms of sales activity, both CREA and BMO are anticipating that sales activity picking up. And CREA is a little bit more reserved in both cases, sales activity and average price. But what does that look like? You can anticipate the overall sales activity to increase and the prices to increase, but not quite as much as the sales activity. That's interesting because if, insofar as that's true, as we head into 2025, there's a strong implication in here that the market, as rates are dropping, this is, I should clarify, sales activity and average price predictions shown here are happening while the A lenders and the Bank of Canada is predicting consistent drops all the way through 2025, including the jumbo drop that just happened, jumbo, quote unquote, that just happened, but also they're predicting another 0.5. This is CIBC predicting this 0.5 in either December or January. And so why would they not be predicting the prices kind of skyrocketing based on demand, pent-up demand and existing demand? I'm theorizing that largely they're not predicting that because policy will be rolled out to keep that tamed, and or interest rates will drop at a little less aggressive rate if the market starts to take off. One of the two of those things, one or both of those things, will likely be put in place in order to kind of tame that market. And insofar as that theory is true, and I do think that's true, and I actually think it's better for the overall housing market if they do it that way. Nobody wants to see the market taken off like it was in the tail end of 2021 and in the first couple of months of 2022. That's not a sustainable market to be in. So I think that theory is probably why these predictions are not aggressively kind of having the prices skyrocket as soon as the rates start to drop, which they have. But that's good, right? Insofar as this, it's good if they do it, and it's good information for us to be able to look forward and see as we're either thinking about buying or selling our primary homes, or as investors looking ahead and looking at what's coming and how can we position ourselves best to do that.